The IRS allows you to save thousands of dollars through a simple strategy that most people overlook, and is simply called depreciation. When you hear the word depreciation, you might think of something losing value, like a car dropping in value the moment it drives off the lot. But in real estate, depreciation is a whole different story. It's actually one of the most powerful strategies for savings on taxes and keeping more of your hard-earned money. By the end of this video, you'll learn 3 key strategies to leverage depreciation to reduce or even eliminate your tax liability. And I've got a bonus tip for everyone who stays to the end of this video. This video is for educational purposes only. It's not financial or tax advice. Always consult a professional for guidance for your situation. Let's clear the air. Depreciation in the world of real estate is not about losing value. It's a tax benefit that allows you to recover the cost of an income-producing asset over a period of time. Experts call it a phantom expense, which basically means it's an invisible expense. Think of it like this. It's something you don't actually pay for, but it does reduce your taxable income, and that can translate into significant tax savings. Now, let me share this quick story on how I learned about depreciation. One of my partners introduced me to a CPA, and he said, this guy does the taxes for the local billionaire. And I was like, shoot, if he's good enough for him, surely he's got to be good enough for me. We started talking, and it wasn't just about numbers, it was about strategies. That's when I learned depreciation can be a game changer. Before, I was paying taxes just like everyone else. But once this accountant and this real estate instructor broke down the federal tax code, I realized I was leaving money on the table. Depreciation turned from a buzzword to a real opportunity to stop overpaying for taxes legally. Here's some of the strategies we discuss. Strategy number 1, straight line depreciation. This method is as straightforward as it gets. You take the value of the property and divide it over its useful life and deduct the same amount every year. When we talk about useful life, we're talking about the estimated amount of years an asset will continue to be valuable and generate income. Useful life for residential properties is 27.5 years, and useful life for commercial properties is 39 years. Here's the breakdown. Imagine you buy an apartment building for $3.3 million, and the actual land value is $550,000. So in order to calculate the annual depreciation, you have to deduct the land value from the property acquisition price. Since the land value cannot be depreciated, it's excluded from the calculation. That leaves $2.75 million for depreciation. So over 27.5 years, you can deduct $100,000 annually, which is 3.6% per year of the building value. So why does this matter? Imagine this. You have $75,000 in net cash flow from an apartment building. Thanks to depreciation, you can deduct $100,000 from the cash flow, leaving you with a negative $25,000 paper loss. This loss can be used to offset your active income, like your W-2, your 1099, reducing the amount of taxes you owe. And I promise you, this is one of the strategies billionaires use to pay less to the IRS year after year after year. Strategy number 2. This strategy lets you maximize your deductions, allowing you to claim a significant portion up front in the first year. Here's what you need to know. In 2025, you will be able to deduct 60% of the qualifying costs immediately for the tax year of 2024. Now, this is down from the initial 100% deduction, but it's expected to return with the future Trump administration. Now, let's continue with our previous example. Now, imagine you spend $100,000 on property improvements. With straight line depreciation, you can continue to take $100,000 over the useful life of the property. With bonus depreciation, you will be able to deduct an additional $60,000. Why? Because that's 60% of the property improvement. This is because you can take a 60% deduction in the taxable year of the renovation. What about the remaining 40%? What happens with that? Well, 40% of the remaining property improvement you can take as straight line depreciation. That total will be added to your existing $100,000 straight line depreciation. So in order to calculate that, we divide 40,000 divided by 27.5 years, which equals $1,454, which in total means straight line depreciation is now in total $101,454. Add for bonus depreciation, which is $60,000, which means in total you got a depreciation deduction of $161,454. Now, some of you may be thinking, why can't I just deduct the renovations annually anyway, regardless of bonus depreciation? Well, here's why. Under the federal tax code, property improvements or capital expenditures are not tax deductible. Therefore, the improvement cost will be added to your total basis, meaning now be based on your all-in cost and would normally follow the straight line depreciation method. Why it matters? This is how you leverage the tax code and make it work for you, maximizing savings and using that to reinvest in growth opportunities. Strategy number 3, accelerated depreciation with cost segregation. Let's talk about another powerful strategy. Accelerated depreciation using something they call cost segregation or cost segs. Here's how it works. Instead of using your asset as one big property, you break it down in parts that depreciate at different rates or different useful life cycles. Things like furniture, fixtures, landscaping can be written off faster than the structure itself, which means you can claim bigger deductions earlier. For example, let's say you buy a property for $2.7 million. After a cost seg study, you might find out that $500,000 covers furniture and fixtures that can be depreciated over a 5-year period. $750,000 is for landscaping and parking lots, depreciated over a 15-year period. The remaining $1.5 million applies to the building structure, depreciated over 27.5 years. By doing this, instead of just using straight line depreciation, you're looking at over $200,000 in annual deductions. That's a huge boost compared to the standard methods. Why does this matter? Well, let's think about it. Getting larger deductions up front means you keep more cash in your pocket. You can use that to reinvest and grow your portfolio or just have more financial flexibility. It's about maximizing your savings when it matters most. If you found this information informative, kindly subscribe and hit the like button. It really helps me to bring more content like this to you. Here's a few bonus tips for all of you who stayed this far. One of my favorites is the 1031 exchange. This allows you to sell the real estate property and roll all of the profits into a new property without paying any capital gains right away. The taxes are deferred as long as you keep it in the 1031 exchange. It's like hitting the pause button on those taxes, which gives you more money to reinvest. Another great strategy is opportunity zone. These are areas where the government provides big tax incentives for investments, usually in undeveloped neighborhoods. It's a win-win. You save on taxes and you're helping transform communities and neighborhoods. Finally, there's a short-term rental loophole. This allows you to claim tax benefits without qualifying as a rep, real estate professional, provided you meet certain criteria. Here's how it works. If you rent out a property on a short-term basis where the average stay is 7 days or less, and you actively participate in managing the property, the IRS allows you to use the property's depreciation and expenses to offset your active income. This can lead to substantial tax savings, especially for individuals who don't qualify as full-time landlords, but still want to benefit from the tax advantages from real estate. So here's what you really need to know. Depreciation isn't just a tax break. It's a tool to build wealth and keep more of your hard-earned money. When you combine strategies like straight line depreciation, bonus depreciation, and cost segs, you're not just saving on taxes, you're taking control of your financial future. If your accountant hasn't done this for you, let them know now, and they will know you're ready for the next level. I've literally used all these strategies to help avoid my federal taxes, and you can use it as well. If you start using these strategies, you will not only reduce your taxes, but you will completely change how you approach real estate investing. If you found this information useful, look, guys, you gotta share this, you gotta save it. Share it with somebody that could utilize this in their real estate strategy as well. And make sure you hit that subscribe button. And as always, God bless you, God keep you. May God bless you beyond your belief, but not your capacity. And remember, you're just one big deal away. Peace.